Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Intel Corporation, ticker symbol INTC. So Intel Corporation has been a value investor favorite, especially on YouTube, as the company has been engaged in a turnaround story after their current CEO, Pat Gelsinger, came on board in February of 2021. Intel is a large position in Seth Klarman's portfolio. Even though he recently cut that position in half, it still makes up about 5% of his public United States listed portfolio. So Seth Klarman is allegedly one of 3 people who Warren Buffett said that he would trust investing his own money. It is interesting to see that he has a stake in Intel, which is a turnaround story. A lot of times value investors shy away from these types of businesses, but we're going to be looking at the fundamentals behind Intel today to see why Seth Klarman may have been attracted to the business and what potentially it looks like for the business going forward. Intel is currently trading at $33.36 per share. Year to date, their stock price is down 35%. So this is coming on the back of some weakness for the semiconductor market overall, as well as a pretty terrible earnings report for Intel this most recent quarter. They had weakness in both their server sales as well as their overall PC sales. But Intel has a lot of moving pieces and a lot of work going on behind the scenes. They've announced that they're partnering with Brookfield Asset Management to build new fabrication facilities in Arizona. And the company is also spinning off Mobileye, which is a company that they had acquired in Israel, focused on autonomous driving. Intel has a lot going on and a lot to be interested about. So currently they're down 35% so far this year. Over the past year, they're down 38%. Going back 3 years, they're down 24%. Over 5 years, they're about flat. They're down 2%. So even though their stock price has bounced around over this time frame, it's still about the same. Over 10 years, they're only up 3.6% compounded annually. And going back prior to the global financial crisis, Intel has only returned about 2.6% compounded annually in their stock price. Keep in mind that this is not including their dividends, and Intel is currently paying out a 4.3% dividend yield, so well above the overall average in the market, and a very high dividend yield for a technology company. So Intel is trading 1 penny over their 52-week low, so that's as close as we can get. They are down more than $20 from their 52-week high. The business has been cut by over 40% there. Intel is a very large business. They have a $137 billion market cap, so this is a big fluctuation for a big business. For some more background on Intel, Intel is the world's largest logic chip maker. It designs and manufactures microprocessors for the global personal computer and data center markets. Intel pioneered the x86 architecture for microprocessors. It was also the prime proponent of Moore's Law, which was named for one of Intel's co-founders, for advances in semiconductor manufacturing, though the firm has recently faced manufacturing delays. While Intel's server processor business has benefited from the shift to cloud, the firm has also been expanding into new adjacencies as the personal computer market has more or less stagnated, although it was boosted significantly by the pandemic. They've expanded into areas such as the Internet of Things, artificial intelligence, and automotive. Intel has been active on the merger and acquisitions front, acquiring Altera, Mobileye, and Habana Labs in order to bolster these efforts in non-PC arenas. Intel was incorporated in 1968 and is headquartered in Santa Clara, California. So for our fundamental analysis today, we are going to be using the Select 6 analysis, taking a checklist approach of 6 standard financial metrics to come to a holistic and beginning understanding of Intel based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. So with that background about Intel and this disclaimer, let's get right into our analysis. Starting off with our first metric, we want their average return on capital over the last 5 years to be above 14%. So we have 2 reasons for this. The first is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these underlying business returns are captured here by return on capital. The second reason is that the average publicly listed business earns about a 7% return on capital. So by asking for a 14% threshold, we're building in some margin of safety by only looking for quality businesses that are at least twice as good as average. So in the case of Intel, Intel has been earning high returns on capital that are significantly above average, but they have been coming down over this time frame. So averaged out, Intel's return on capital is about 19.5%. So this is going to be a check for us to start off here on our first metric. However, their return on capital has been declining since 2018. And we can see that scrolling down and looking at the last 12 months, their return on capital has actually gone down to about 9%. So that would still be an average return on capital that's higher than this 14% metric, even if we're including 9% here. However, it's important that we do the work to understand what's going on behind the scenes at Intel and what they've disclosed through their corporate filings and what they've said during their earnings call to really get a sense of the transformation going on and being undertaken at the business. So that's homework that's going to have to be done on your own to dig in and learn more about Intel. We do not want them to be stagnating on returns on capital that are just about average. We want them to have returns on capital that are significantly higher and above average. And so that's something that you want to learn more about and determine if their returns on capital are going to keep dropping and stagnating in the high single digits, or if they're going to return to some of these higher trend numbers. Anyways, that's a consideration you have to make for yourself, and this is a check for us to start off here on metric number 1. Next up, for our second metric, we're taking a broad look at the company's financials overall. Here we're looking for revenues, net income, and free cash flow to be growing over the last 5 years. So this is an all or nothing metric. Either all of these metrics have been growing for it to be a check, or if even one of these is down, this is going to be an X. In the case of Intel, they've grown revenues, they've more than doubled their earnings. However, their free cash flows are down slightly, down about $700 million, which does sound like a lot, but for a company the size of Intel, bringing in over $10 billion of free cash flow in 2017, and then just under $10 billion in 2021, while it is a decrease, it's not as bad as it looks percentage-wise. However, this is going to be our first X on our second metric as their free cash flow has begun to fall. Then for our third metric, here we're looking at earnings per share growth over the past 5 years. This is going to be similar to the metric we just looked at, but here it's taking into account shareholder dilution. So Intel has more than doubled their earnings per share over this time frame. They've had pretty steady earnings per share in each of the last 4 years. As we can see here, relative to their earnings growth, Intel has both been buying back shares and increasing their earnings, so this is a good sign to see for long-term shareholders. Metric number 4 is taking a look at free cash flow per share growth over the past 5 years. So here, this one is actually going to be a special case. So in the last 5 financial years, they have grown their cash flows per share. They've grown this from $2.20 per share in 2017 up to $2.38 per share at the end of 2021. However, if we scroll down, in the last 12 months, Intel has actually produced negative free cash flows per share. But although their fiscal years reflect a positive increase here, because they're producing negative cash flows per share, and that's pretty bad relative to their historical performance, this one is going to be an X to give us a more up-to-date picture of the business. The reason for this is that Intel has been spending a ton of money in capital expenditures recently. It costs anywhere from $10 to $20 billion to open a new semiconductor fab. And Intel has announced that they're opening fabs in Arizona for $20 billion, which they're partnering with Brookfield Asset Management on. Then they also announced that they're opening a huge fabrication, one of the largest in North America, in Columbus, Ohio. They're receiving financial backing from the CHIPS Act for that. In addition to this, Intel is also going to be opening less innovative but highly expensive fabrication sites in both Italy and Germany to support the European automotive industry. So Intel has just been spending a lot of money on CapEx in a high inflationary environment. So Intel has been spending a lot of money on CapEx over the past year, and that's going to continue for at least a couple years into the future. To recap where we are so far, so out of 4 metrics, we're split 2 checks and 2 X's. Let's keep going. Next up, for our 5th metric, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below the amount of free cash flow that they produced in the past 5 years. As of the end of last year, Intel had about $8 billion of net debt, and over the past 5 years, they produced $72 billion of free cash flow. So that is more than 9 times the amount of net debt that they have. Intel is in very healthy shape to be able to pay off all of this debt and then some. They really have not taken on much debt at all relative to how they produced free cash flows. So this is a strong sign to see of a conservatively financed balance sheet here at Intel. This is a check on our fifth metric. Then lastly, we want Intel to have an average 5-year free cash flow yield relative to their total enterprise value that's greater than 5%. So this will give us both a risk premium to the risk-free rate and will potentially build in some margin of safety if the business is above this. So in the case of Intel, currently they have a total enterprise value, which is their market cap plus their net debt, and is reflective of what the business would look like as a private entity. That is $144 billion. So in the past 5 years, they've generated $72 billion of free cash flow, which works out to $14.4 billion of free cash flow a year. So when we divide $114.4 billion of free cash flow by their enterprise value of $144 billion, that gives us an average free cash flow yield to enterprise value of 10%. So that is more than double that metric we're looking for. They have historically generated a ton of cash relative to what the business is priced at today. However, as we've seen, Intel's free cash flows over the trailing 12 months are actually negative. Even if we rerun this metric using their last 12 months of free cash flow, in addition to their last 4 years of free cash flow, Intel is still producing $60 billion of free cash flow over that time frame, which is $12 billion a year. If we divide 12 by 144, that's still an 8.3% average free cash flow to enterprise value yield. So pretty much no matter which way you slice it, even with Intel's huge capex in the most recent year and for a couple years in the future, if they can get back to where they have been historically, Intel would be producing a ton of free cash flow relative to what they're currently valued at. This is some of the potential reasoning for why a value investor like Seth Klarman may have been interested in the business originally. He might not have expected them to spend so much on capex, especially in a time where we've seen inflation tick up. That makes these capital expenditures just more costly. But it does give us insight here that if Intel is able to get back to these historical numbers, that the business could look potentially pretty cheap right now. However, that's a big if. This is dependent on their turnaround. And right now, both their return on capital and their free cash flow numbers are coming down from being pretty good historical averages. So if it works out, that would be absolutely excellent for shareholders and you'd probably do quite well. However, there is the real chance that this could fail in such a highly innovative and technical industry, and that could pretty much leave Intel behind. So it looks like there is both upside and downside with Intel's business, and so this is a business that you're just going to have to learn more about and do your own homework on to come to your own independent conclusion. Lastly, here we're looking at their dividend profile. As mentioned, Intel is currently paying out a dividend yield that's above 4%, so one of the higher dividend yields in the overall market and one of the highest dividend yields for a technology-based company. So in all of the past 5 years, Intel has produced more than enough free cash flow to cover this dividend, and they've increased their dividend in each of the last 5 years. Management has said that they plan to steadily keep increasing this dividend and keep it healthy going forward. However, based on their last 12 months, again, Intel has negative free cash flows per share, so they would not be able to support this dividend just based off their abilities to produce free cash flows. They have to support it either through additional capital raises or by selling assets. So although it's nice to have a dividend, if Intel truly believes that their shares are undervalued at this current stock price, then it would be a more prudent capital allocation decision to cut this dividend and start repurchasing shares so that they both don't have to pay out this dividend and potentially compromise their financial health while they're not producing free cash flows, so that they'd be able to save money here and that they'd still be able to return capital to shareholders. Dividends are inefficient for investors anyways, as they're both taxed at the corporate and individual level. So really, that decision, although it might seem drastic and might get hyped up, would really be a win-win for both Intel and their shareholders, but it would earn Intel some seriously negative press. So that's something you just want to keep an eye on going forward. This type of capital allocation decision, if they keep increasing this dividend, is not the best going forward. It's not horrible either, but it looks like it would be for better optics overall, not because it's a sensible thing to do. This is something that could cause pause and give some hesitation here based on this suboptimal capital allocation decision moving forward. So then here we're using a discounted cash flow model to come to a potentially fair value for Intel. We're using historical growth assumptions based on the rate that they've been able to grow free cash flows in the past. If we have a starting point of their average 5-year free cash flows of $3.25 per share, with a 10-year growth period based on their historical growth rate of 7.3%, then a terminal value over the next 10 years where that's almost cut by half, and at today's prices with their tangible book value, you could expect about a 26% return from Intel. But hold your horses. This does not mean that you rush out and buy Intel. These are based off their historical numbers, and we've seen that their free cash flow has taken a huge dive relative to their historical trends. Let's say we cut their growth rates for both their growth and terminal stages to 4.3 and 2% respectively, then you could still expect about a 23% rate of return on Intel from today's prices. So again, these are historical numbers that you absolutely need to validate for yourself. These are historical averages, and these aren't what their current metrics are. Currently, they have a negative free cash flow per share. This is not financial advice. It just serves as a baseline of what you could project going forward based on their historical numbers. It is not a buy or sell recommendation of Intel at any point in time, and please make sure you're both doing your own homework and that you're consulting with the properly registered financial and legal professionals before making any sort of investment decision. These are historical assumptions that should not be construed as being accurate. It's up to you to validate these one way or the other. So in summary, Intel checks the box on 4 out of our 6 metrics. They're earning above average returns on capital. Their free cash flow is down over this time frame, and it's going to continue to stay down for at least the next couple of years based on management guidance and analyst estimates. Their return on capital numbers, while they're above average historically, have been coming down recently, so that's something to keep an eye on here. Their revenues and earnings are up over this time frame, and Intel is using very little debt in their business relative to their historical abilities to produce free cash flows. Again, based on their historical cash flows relative to their economic value, they're trading at about a 10% free cash flow yield right now. As we saw through both that and our discounted cash flow analysis, these are not what Intel is currently trading at. Historical assumptions aren't going to be the best model for a business going forward in any case, but they're especially iffy here on Intel as the business is undergoing a turnaround, and the future is not likely to look like the recent past here. Intel is a business overall that, while there is some uncertainty, it looks like there's both the potential for risk and reward just looking off of their financial fundamentals. So if you're interested in this business, personally myself, I am, it's worth doing more research to learn more about the business. I highly recommend checking out the business's filings, read through their annual reports, and dive into their 10Ks. Also take a look at management's transcripts from earnings calls. They'll help provide a framework for how management is thinking and what their capital allocation moves would look like going forward into the future. Intel is one of the most storied technology companies in the world. They help put the silicon in Silicon Valley. And right now, there's nothing but interesting news coming out of Intel. It's a business that's controversial and value investors are split both ways on, especially as they've had recent poor performance and lowered guidance going on overall. Again, this is a business to do your homework on. Please don't take this analysis as financial advice. It is not a buy or sell recommendation of any security. And please consult with the properly registered financial and legal professionals before making any sort of investment decision. It's important to do your own homework as a value investor, to really learn about a company as if you owned 100% of it and you know that business inside and out. So with that said, that's it for today's fundamental stock analysis of Intel Corporation, ticker symbol INTC. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Intel with me, and have a great day.